Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm sitting down with Frank Thormann, who is a portfolio manager for Schroders. He's going to be talking to us about the Schroder Global Equity Alpha Fund, trading under the ticker ALPH. Frank, thanks so much for sitting down with Livewire today.
It's a pleasure to be here.
Frank, let's start big picture. What are the two or three big trends or macro forces that are impacting your opportunity set right now? And I guess more importantly, how are you navigating them?
Well, actually, the heart of the strategy is not to be able to pick the two mega themes or trends. We run a concentrated strategy consisting of roughly 40 to 60 stocks, and the idea is really for each of them to be independent of each other, rather than trying to be a hero in 1 year betting on AI stocks being right, and then the next year everything falling apart and giving all the performance back.
Frank, the growth gap, it sits at the core of your process. So what are the biggest behavioural or structural market inefficiencies that are leading to gaps right now?
Yeah, growth gap is our language for saying unanticipated, forward-looking earnings surprises. So these are companies where we have high conviction in their ability to perform better than market consensus. The reasons we have that conviction is, one, we're of the view that increasingly the market is myopic, in that they look at what is happening today, what's happening next quarter, but there's very little analysis really trying to understand how is a company going to look different in 3, 4, 5 years and beyond, and that often happens to be a market efficiency. The second market inefficiency is when thinking about the future, often the market extrapolates from the past. They take out the ruler, they see what the last few years have been and expect that to continue. And I think market extrapolation is a reasonable approach in many instances, but not in all instances. So deliberately in this strategy, if we look for companies at a positive inflection point, and where that positive inflection point has not been recognized by consensus.
Frank, just to follow up there, if I may, that longer term view, by definition, it's quite hard to think that way. So what are some of the tools that you and Schroders use to have that 3 to 5 year perspective?
Well, luckily we have a very talented team of analysts which drive that thinking. And usually the types of factors that give us conviction in a company's ability to surprise positively, not this year, but many years into the future, is the identification of deeply rooted competitive advantages, that there's something in the DNA of the company which is just not replicable by competition. For example, really strong intellectual property, a really strong brand that's been cultivated over decades and goes from strength to strength. Or maybe the ability to attract and retain the smartest people on the planet. And despite competition trying, usually it's these companies that just are able to take a bit of market share year in and year out. And often in the out years, consensus doesn't appreciate that.
Frank, you blend core long-term positions with more opportunistic ideas. What are the key differences? And then how do you go about sourcing those two different buckets of ideas?
The common theme, as I've explained, is we expect both of them to deliver positive surprises versus consensus. The distinction is the time axis, where, as we just talked about a minute ago, the core growth gaps is really the predominance of the strategy, consisting roughly of 70 to 80% of our investments. So these are companies where we have that belief in long-term multi-year outperformance versus consensus. Contrast that to opportunistic, roughly 20 to 30% of investments. And here, the duration of the expected investment thesis is shorter, maybe 1.5 to 2 years. So here, the requirement for immediate positive results is greater, knowing full well that maybe after 2 years, the thesis will have run its course.
Frank, let's talk portfolio construction. So how do you balance style exposures, macro risk, and bottom-up conviction, especially when growth and quality, they're becoming more and more expensive?
The idea really is to design the portfolio in a way where the majority of the relative return is driven by the stock picking. For me, it's all about the individual companies. And if I can find 40 to 60 stocks and have an analyst team that deliver these ideas in different sectors, in different regions, with different style exposures, a lot of these factors that you highlight are actually fairly balanced and fairly neutral versus the benchmark. again, with the idea that the relative performance should be driven by the individual stocks rather than the factors.
Yeah. Just to follow up there, if I may, Frank, so there's 40 to 60 stocks in the portfolio at any one time. What's your investable universe? How many stocks do you have in coverage beyond the 40 or 60 that are in the portfolio at any moment?
Yeah, well, it's a global universe.
Okay.
Typically, if the market capitalization is over 5 to 10 billion,
Right.
it's investable. So it's a very, very large universe, which gives me the luxury to apply a really high hurdle rate.
Mm-hmm.
I don't have to find hundreds of great ideas. I have to find 40 to 60.
Yeah. Let's talk about some of those ideas. So you've added names like Monster Beverage, Tapestry, and Legrand. What do they have in common in terms of growth drivers?
Well, what they have in common is our expectation for them to surprise positively, in our language, a positive growth gap. However, the drivers behind those expected positive surprises are very different, and that's really the idea. So if Tapestry fails, it doesn't change the odds of Monster Beverage being right or wrong. So each of them have independent drivers, maybe just to highlight them briefly. So Monster Beverage, our leader in power drinks, we think it's a trend that continues to have a really bright future as it proliferates across different countries and across different use cases. Tapestry is best known for its handbag brand Coach. And the company is currently going through a sweet spot in terms of product design and really professional and creative marketing. That's propelling the brand to deliver these positive surprises. But it's more opportunistic, so we're being really on the forefront of trying to identify the duration of those drivers and also being able to time the exit when the brand perception has peaked. Legrand is an electrical company that's currently going through a positive inflection as a result of the data center built out, particularly in the United States. That's not fully recognized by consensus.
Yeah. Frank, I'm going to ask you for a couple more stocks that you like right now, a couple of names in the portfolio. Can you just talk us through the bull case on a couple of names you're liking at the moment?
Netflix is one of our largest overweights. Netflix for sure has been successful in the past. At the same time, I continue to have conviction that there's powerful drivers that are not recognized, specifically their pricing power. So we analyze Netflix looking at the engagement as measured by the average viewing per subscriber per month. That work suggests that the average Netflix subscriber watches 2 to 3 times as many hours as on competing platforms. It's our view that historically the company has been more cautious in using its pricing muscle because they preferred to gather more subscribers. Going forward, that formula is going to change somewhat, where they're going to be a bit more aggressive in using that pricing power. And importantly, we feel that pricing power hasn't been recognized by consensus is going to drive really strong positive surprises going forward.
Just before you get to the next stock, Frank, I just wanted to ask, just for the audience, what are you watching on Netflix at the moment? What's the show you've been watching? Is there anything that's top of the pops for Frank?
Well, I have to admit, actually, I haven't been watching that much Netflix.
Not while you've been here,
the last thing I've watched was Adolescence, which really touched me, actually.
There you go.
Having kids in a similar age.
Yeah, I must check that out. I've got 2 young boys and I've been told I need to watch it. Sorry, I'll let you get on to the next stock. What's another name that you've got for us?
An opportunistic investment case is SharkNinja, which I hear also selling product in Australia.
That's right, yeah.
And what's fascinating, what's captivating about this company is they operate in fairly mature and boring segments. They make kitchen appliances, home cleaning devices. Nothing that would usually generate lots of excitement, but they've come into these categories with lots of excitement, innovation, product design, and have really been able to capture customer interests. And as I said, in categories that are not growing very fast, been able to quite rapidly take market share. What gives us conviction and that there's more positive surprise to come is that often they roll out products in early markets first, and when that's successful, they keep rolling them out in other geographies and other segments. So it gives us quite a bit of leading indication. In addition, we try to employ some alternative data sets in trying to capture vibrancy around the brand, Google search activity, key opinion leaders, test results, and all of that points to a very strong current backdrop and strong likelihood for positive surprises in the shorter term.
Yeah, because that is a very competitive space, isn't it, that they're operating in. So interesting, those data sets that you're looking at to get the way the market's feeling about the products. Yeah, good stuff. Frank, you've spoken about avoiding glamour stocks, momentum stocks. We're still in a market, though, it's dominated by the Magnificent Seven. So how do you resist that pull of those, big, large cap names? There's so much money flowing towards them. How do you try and stay away from them?
Well, I would answer the question in a nuanced way. There's certainly potential of glamour stocks to keep outperforming.
Yep.
Netflix we discussed, I would put in the category of a glamour stock. It's one that's not undiscovered. It's one that's done really, really well. How I make the distinction between which glamour stocks are overdone and have seen the limelight of the day, and which ones haven't, is really this forward-looking approach. Not to take comfort into what's been reported historically, it's a bit watered under the bridge, but have a really clear view to the future, asking the question, does this company still have the ability to surprise positively going forward? If and when we have that conviction, for example, Netflix, I'm very happy to keep running a position like that, even when it becomes characterized as a bit more of a glamour stock.
Last one for you, Frank. Markets seem to be rewarding active managers after a tough few years. Do you believe we're in a new regime change for stock pickers? And if so, what's driving that change?
Well, actually, this philosophy and process we've described and looking for forward-looking surprises, we've been implementing it very, very consistently. I've been the lead manager for the strategy since 2018, and the process and the philosophy has not changed, and we've been able to deliver very strong results throughout the years. So my philosophy and process is unchanged, and it's my belief that earnings surprises are going to continue to be rewarded going forward. So I'm very positive about that strategy to continue to deliver good results.
Frank, thanks so much for sitting down with Livewire and taking us through that. Well done.
It's been a pleasure. Thank you.
If you enjoyed that interview, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.